True greatness is a rare thing. Over 4,000 U.S. businesses trade between the New York Stock Exchange and the NASDAQ alone, and only a very small handful of those are even worthy of consideration in a long-term portfolio. And even fewer pass through our own rigorous criteria. We research, we study, we attempt to uncover what makes these businesses so high quality in the first place. However, there are some businesses that possess characteristics so rare, economic moats so wide, and growth so robust that these are not just buy and hold forever stocks, but worthy of DCA along the way. Welcome to The Quality Investor. Today, we are discussing 3 businesses with such phenomenal economic traits that even after we make our initial investment, at a fair price, of course, we continue to dollar cost average into that stock, even if it drives our cost basis upwards. Long-term growth in our portfolio doesn't come from capital appreciation alone. We must keep adding to it over time. Think about the simplest investment plan for a second. Someone who has a set it and forget it strategy. These people just make regular contributions to their 401k or IRA, and all they have in there is just a S&P 500 ETF. They are basically dollar cost averaging into 500 businesses all at once. Also, remember to hit that like button below and make sure to subscribe to the channel to stay up to date on all the high quality businesses in the market. The idea here is simple. We want to construct our portfolio in a way that we treat it like an index fund. When I got into picking stocks for my own portfolio, I was way too concerned about buying in at the right price. I would make that big investment initially, but then I would wait, and I would wait until that price came down so I could buy more and lower my cost basis. I was so concerned about getting my cost basis down, but some stocks just kept growing. I quickly realized, though, that by waiting, I was missing gains from my winners and only adding to my losers, which is the anti-Peter Lynch strategy. Truly great businesses, they're going to have their drawdowns. That's a fact. But they keep growing far more than not for a reason. I decided that for the core positions in my portfolio, I was just going to DCA. These are such good businesses that I wanted to keep adding to them on a regular basis, even if that drove up my cost basis. And when there were large drawdowns, that's when I would take some cash that I had waiting on the sidelines and really load up on these businesses, just like DCAing into an index fund. So the 3 stocks that we're going to discuss today are, in my opinion, worthy of forming the core of any portfolio, worthy of DCA, worthy of holding forever. So let's get into 3 of the best businesses on the planet. There are 3 main criteria I have for these. Number 1, have a consistently high return on invested capital. Businesses that consistently have return on invested capital that's higher than the cost of that capital will create value over the long term for shareholders. Even if a business is growing at 20% a year, if their return on invested capital is lower than what they're paying for that capital, they're going to destroy value. High ROIC is an absolute must. Secondly, these businesses reward shareholders by returning capital either through dividends or share buybacks. This is actually a secondary effect of having a high ROIC. If a business has such high returns on invested capital, they're going to have excess cash. Some businesses simply cannot invest and get the return that they require on their investments. So after reinvestment to continue their growth, all that extra cash, they're going to return it to investors. And third is an economic moat that is so wide, it is deeply woven into the American fabric. We simply cannot imagine life without these businesses existing. That'll become a little bit more clear as we go through the list. So let's get into that list right now. First up, we are looking at Costco Wholesale, ticker COST. Costco, of course, is one of the best retailers on the entire planet. I've done videos on them in the past showing how incredible the economics of their business model really is. What sets them apart from other retailers is their subscription model, their membership. Looking at their return on invested capital, my first criteria, in 2014, it was at 14.5%. Fast forward to today, and you can see that return on invested capital has increased to 22%. Their return on capital employed, ROCE, is even better at 33.6%. ROCE is slightly different calculation than ROIC. It uses operating cash over assets minus current liabilities. Whereas ROIC is NOPAT over invested capital, or net operating profit after tax over the invested capital. So I said that ROIC is one of my main criteria. And the way to increase ROIC is improving your margins or improving your capital efficiency. So what Costco is doing is they've really improved their operating margin. Their gross margin's always going to bounce around in the 12 to 12.5% range. But their operating margin has gone from 2.86 10 years ago all the way up to 3.42. That doesn't seem like a huge increase. However, here's some context around it. Their membership revenue accounted for 2% of their total revenue. However, it is 56% of their entire operating income. Now, 6 years ago, that membership revenue, that was 70% of their operating income. Wait a minute though, doesn't it seem like that's going backwards? Their membership revenue is a less percent of their operating income than it was 6 years ago. But this is what's going to actually drive value going forward for Costco. Let's look at their expenses real quick. Let's look at their SG&A margin as a percentage of gross profit. 10 years ago, it was at 76.8%. And today, it's sitting at 72.5%. What they've done is really drive down the cost of their overhead while simultaneously increasing overall membership. Every additional membership is pure profit for Costco. And their growth plan in the next 10 years, part of it is adding 275 more stores. But along with that, growing their membership base at each store by about 4.5% to 5%. If they achieve that, that's going to really explode their operating margin and thus increase their ROIC. The other part of ROIC is their CapEx spending, improving capital efficiency. So you can see that 10 years ago, their CapEx as a percentage of operating income was at 62%. Today, that's at 52%. Part of Costco's plan is expanding the number of stores on an equal increment every single year for the next 10 years. Meaning their CapEx spend will remain relatively flat while their operating income is only going to increase, especially when they increase that membership. So they're simultaneously increasing their ROIC by improving their operating margin and improving their capital efficiency. This is Costco's sources of cash. You can see here, they're primarily funded exclusively by their operating cash. Not only that, they have a positive cash to debt ratio. All that extra cash they generate, they can't reinvest all that back into the business. Costco can only use so much of that cash to reinvest back into the business to generate their future growth. They do that primarily, of course, through their CapEx spend and expanding their stores. This is Costco's capital allocation over the last 22 years or so. You can see they generated $10.6 billion in operating cash flow for their trailing 12. They only reinvested about $4.4 billion of that to continue their store expansion, meaning they pay out a huge amount in dividends every single quarter. This trailing 12 dividend payment of $8.8 billion includes a special dividend, but you can see historically they have quite a few of these large special dividends. That's due to how much cash Costco really generates. And because their stock price is always pretty high, they don't do a lot of stock buys. They just instead return their capital to shareholders by dividends. So finally, the last reason why Costco is such a great business to simply just dollar cost average into over time is just their massive economic moat. They almost have a cult following. See that video that I did on Costco's business model. It's just an incredible business with an incredibly wide economic moat that just can't help but make money. So Costco will be a very great business long into the future. The next business we're looking at is the incredible Visa. Visa is as close as you're going to get to a money printing machine. You can see their ROIC is at 42%. It hasn't decreased much from 10 years ago, but it's consistently incredibly high. I've done videos on Visa's economics as well, so you should definitely check those out for a primer on that. But what makes Visa so valuable is their incredible margins. Their gross margin 10 years ago was at 81.25%, and even today, it's still at right under 80%. Their operating margin as well, 64% 10 years ago through 67% today. So again, they're slightly increasing that operating margin. And you can see why the operating margin has improved so much. It's because they're doing a great job of keeping their overhead under control. The other thing that makes Visa so special is they're very capital light. They essentially only need to reinvest every single year about 5% of all their operating income back into the business to continue their pretty much 10% annual growth. All of those operating profits, of course, what do? They come back to shareholders as free cash flow. And exactly like Costco, Visa, as we can see their sources of cash here, can fund itself exclusively through their operating cash. What's more interesting though, is Costco right now is trading around a 47 PE. Visa is actually at about a 31 PE. Visa is a lot cheaper on a PE basis than Costco is. And because of that, they can return capital to shareholders not only with dividends, but also share buybacks. So now looking at Visa's capital allocation, you can see the incredible amount of operating cash that they generate, $20.2 billion on a trailing 12 basis, of which they use $12.5 billion of that to buy back their own shares. And you can see this red line here. They buy back an incredible amount of their shares over time. And of course, you can see this yellow line, this dividend, slowly creeping up over time as well. So Visa's growth is almost completely organic, and all that extra cash they're generating, they're simply just returning it to shareholders. It's very difficult for Visa to find projects that have that very high ROIC that they're looking for. So they just give it back to the shareholders. When it comes to Visa's economic moat, there's two primary factors. The first is they operate essentially as a duopoly with MasterCard. MasterCard has economics that are pretty much as good as Visa's and is also a wonderful business to own. I simply just chose Visa over MasterCard. The other aspect of Visa's moat is think about their brand awareness. Wherever you go in the world, every single person has Visa in their mind. They know what Visa is. It's accepted at nearly every place you go in the world. So it has a huge penetration in markets all over the globe. On top of that, a majority of the world's transactions are still done in cash. Visa, of course, wants to convert those transactions to card transactions. So there's a very long runway for growth in Visa. The final business we're looking at today is Microsoft. Microsoft needs no introduction. They're almost synonymous with operating systems on PCs, and it's almost impossible to find any US business that doesn't use Microsoft Office in some way, whether it's Word, Excel, Outlook, and yet that's just a tiny part of their entire business. 10 years ago, Microsoft's ROIC was at 23.8%. They've increased that to an incredible 38.2% today. What's interesting to look at here is you see they had a large gross margin back in 2014 of nearly 70%, and it dipped down a ton in the next 2 years before shooting back up to today. It's right in this time frame when Satya Nadella took over as CEO of Microsoft and essentially transformed the business into a cash machine. One of the first things they did was convert to a subscription model. And subscription revenue is one of the best sources of revenue you can have. But in doing so, increasing their ROIC, they've not only increased their gross margin, they've also increased their operating margin. So they're getting their cost of goods sold down as well as their overhead down. Looking here at both their cost of goods sold, their margin, this line here, as well as their SG&A as a margin of gross profit, both of them just declining massively over the last 10 years. Microsoft's CapEx, however, is increasing a little bit more as a percentage of their operating income, meaning they have to reinvest a little bit more in their business. A part of that, though, is the huge investments they're making into AI, as well as the data centers for their Microsoft Azure. Of course, the idea here is that Microsoft sees those investments. Yes, they're going to be outlaying cash today, but they see a huge ROIC on those investments, or else they wouldn't make those investments. That doesn't mean it's going to pay off, but that's the primary reason by the increase in CapEx as a percent of operating income. And of course, if they do pay off, if they do have that large ROIC generative event, as shareholders, we're only going to benefit. Looking at Microsoft's sources of cash, you can see that they're also self-funding by operating cash, just like Visa and just like Costco. So another example of a business that generates just so much cash that what are they going to do with it? Well, they are making large CapEx investments, but because they generate so much cash, in fact, they generated $102.6 billion in operating cash on a trailing 12 basis. Not all of that's going to be used for investment to grow. And of course, they're going to return that to shareholders. And looking at Microsoft's capital allocation, you can see it's a little bit more balanced than Visa and Costco. Well, they've done an excellent job increasing that operating cash over time. They are investing a little bit more in CapEx than the other two. However, the dark red here and the yellow, that's going back to shareholders every single year. Microsoft is also on the verge of becoming a dividend aristocrat. So we should see some excellent dividend growth out of Microsoft over the next few years. So those are my 3 picks for businesses that can create the core of any portfolio. They have great ROIC, they return capital to shareholders, and they have incredibly wide economic moats. The combination of those 3 things will drive immense value for shareholders over the next few years and possibly decades. And because of that, well, there'll definitely be dips here and there for each of these businesses. Their value's only going to go up. So a dollar cost averaging strategy might also be a great strategy. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.